I'm curious a little bit about kind of your backstory. I know that you have quite an extensive backstory. I kind of want to hear a little bit about Uppercase Living and kind of what that experience was like, because I know that there was a really cool path that you took in that way.
Yeah, that was interesting. I mean, I don't know how far back you want to go, but at the very beginning, this was my wife's idea. And my wife is a graphic designer, and she saw some vinyl lettering that was an outdoor application and said, I think we could do this indoors. And she figured out, did all the research and said, here's what's going on. There's these vinyl cutters that you can cut this material and then it sticks to these surfaces. And at the time, the vinyl, it was meant as an outdoor application. And so she said, we want to take this to an indoor application. And she started making all these designs that would go into a home, whether they're like quotes or words on the wall. And this was before Cricut and all the craft cutters and things like that. But when she told me about it, I'm like, yeah, whatever, go for it, go do it.
You're like, I trust you.
Yeah, so and it was like, if you can make your money back, that would be awesome. But she saw this as a business, and she would seriously just go out and share this with all of her friends, and they would share it with their friends. And all of a sudden she had more work than she could handle, and she would come home and go, Jeff, I just made $1,000. And she'd just been over at a friend's house sharing this with everybody. And I was like, whoa, 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 no, no, don't go spend that, because that you did not make $1,000. She would stay up all night trying to plot all of this stuff and get it, but she absolutely loved it. And it just got to a point where it wasn't scalable. And I ended up helping her raise some capital, and we shut things down and had this company or an investor come in and helped us retool everything and get it to where we could automate a lot of the manufacturing. And so we shut things down for about 3 months, got everything ready to roll out, and it just kind of took off. We did like $1 million in sales the first year. The next year we did 14
Wow.
million, and then it went to like 24 million. It got up to like 40 million in sales in just a matter of like 4 years. So
Holy
yeah,
cow.
it was a fast and crazy ride. I remember one year we moved warehouses like 3 times, and it was just
Just because it
insane.
was growing so fast?
Yeah, could barely keep up with the growth. So yeah, those were fun
Wow.
times. And then we kind of hit a peak, and then that was the fast growing part. And then we kind of hit some hurdles and started riding it down the other way. So it was really fascinating to be involved on both sides of the hyper growth and then the just trying to survive mode at the same time.
That's so wild. While you guys were doing all of that in sales, were you also raising funding, or were you just was it just organic growth that way?
Yeah, actually, we cash flowed after about 6 months of operation. So after that initial investment, we didn't need any more funding. Very, cash flow oriented business. We collected everything up front and then manufactured and delivered healthy margins. And we grew it to about 350 employees. At that point in time, we were looking at selling the company, and we kind of pulled back and said, okay, everything's got to be about our EBITDA. How much profit can we pull into this? So you're starting to make cuts, and you start to cut, making all these cuts to get the EBITDA number as large as possible, and you
Mhm.
start taking your eye off of growth. And at that same time, we had investors that were looking at actually potential acquisitions, and we ran into the housing crisis of 2008, where capital just dried up. I mean, I remember talking to investors one day, and the next
Mhm.
day, Lehman Brothers goes under, Bear Stearns goes under. I mean, it was crazy times where capital just froze up, and there was no capital to be found, and so we had to kind of pivot and say, yeah, an acquisition's not going to happen, so we got to rethink how we're looking at the future here.
That's a super wild. That's such a crazy journey. Like to take a company from, I don't know, literally nothing to 40 million in 4 years is just insane. And then having all of it be cash flow is just super impressive. How did you get into Carta from there then? Was Carta just kind of like your next thing after that, or were there pieces in between?
It's interesting. I took a break. We ended up selling the company, and I stayed on for a few years and helped run it. But after that, I took a break, and I came across this company called eShares that was based out of San Francisco, and they had this crazy idea that they wanted to bring liquidity to the private markets. And I thought that is the coolest
Hmm.
idea. I love what this company is trying to do. And it was kind of a pipe dream at the time. This was a cap table management company that had software that helped companies issue equity, which was also very cool at the time because I mean you're now digitizing all of the documentation, all of the securities that are getting issued out to
Hmm.
investors or employees. And so you've at least got it in a digital mode, and you're starting to kind of be more like the public markets, but a long way away from bringing liquidity and creating a private market, I guess. But over the last 3 years, so I ended up joining when they opened up a Salt Lake City office. It was kind of fortuitous that they chose Salt Lake, and I had been following the company. And so when they moved to Salt Lake, I jumped on. And over the last 3 years, it's been amazing to see how Carta has grown. We rebranded to Carta, and it was just fascinating to see that out of that cap table management software, that became really the infrastructure to do all kinds of things. Because once you have that data, it makes it a lot easier to do 409A valuations that all of these companies needed. We had all the data and all the front end work was already done through the software, so the analysts could focus on just doing the valuation work. And so
Hmm.
quickly, Carta became the largest provider of 409A valuations in the space. We're now doing like 10, we're doing as many 409A valuations as our next 10 closest competitors combined. So, I mean, we've really kind of taken
Wow.
over that market. But then it led into things like fund administration for the VCs, where you have all of this data that can get leveraged, and the VCs can now try and get all of their companies onto Carta. Even those that
Hmm.
aren't on Carta were pulling all that data in using the software. So now they have real time, you know,
Yeah.
communication with their LPs and their investors. But I mean, it's just fascinating how these things have kind of evolved out of the simple notion of capturing the cap table management market.
Yeah, that's I feel like a lot of our questions are going to be specifically around why is this information important, and to give a little background for like the main topic of our conversation is like at some point when you're in tech, you're either going to get angel investment. And be able to cash flow the rest of it from there, or not. Like 99% of the time, you're going to probably seek outside investment. And I'm guessing there's probably a couple key things that a lot of these founders are going to have to present to these VCs in order to get any form of investment.
Yeah, and Jeff, to kind of give you an idea too, a lot of the people who are listening right now are people who, and let's talk to our listeners that are at the point where, listen, we validated our idea, it's a great idea, we just need to figure out how to fund it. And I feel like a lot of these people are trying to build partners, right? They're building their core team, and maybe even doing angel investors and the different type of investors and investments. Tell us, what does Carta do first? Let's just kind of break down how Carta can help someone that's in that position right now.
Yeah, great question. So at the very fundamental level, when a company decides to bring on investors or even other co-founders or individuals they want to share equity with, they have to keep track of that.
Yep.
Carta has a software platform that makes it easy for you to issue that equity, whether it's through shares or units if you're an LLC. But you're issuing equity to these individuals or to your investors. When they invest money, you give them equity in the company or ownership in the company. Carta keeps track of all that. And then as you start to go down the path of issuing stock options to employees, you're going to run into vesting schedules and keeping track of whether they're qualified ISOs as stock options, incentive stock options, or if they're non-qualified for your advisors. And you've got to keep track of all of this stuff. Carta software makes that easy to do. And one thing that's kind of cool is that if you're an early stage startup that has raised less than $1 million and has 25 or fewer stakeholders, you can use Carta for free. So it's free for those early stage companies that are preparing to, maybe raise a round of funding, which really puts you at an advantage when you're going into the fundraising mode, because you can then model things out in your cap table and say, okay, if we raised $5 million at this valuation, what would that do to our dilution, as founders? But you can model things out. You can also create data rooms and things like that in the software so that you're prepared to go in and present to your investors, if that makes sense.
Well, and to go along with that, tell me about the different type of investors who would use this type of information. And honestly, it sounds like you work with a lot of different venture firms. Is that right? Whether it's venture, do you work with angel investors, private investors? Kind of what are the different types? Do you work with all of them?
Yeah, absolutely. I work with a lot of angel groups, a lot of VCs, a lot of accelerators. But in all those cases, the investors, regardless of what stage, they're going to want to see your cap table. And they can tell a lot from your cap table that you might not realize. Just by looking at your cap table, they're going to make sure that you as a founder have enough equity left in the company that you can get it to where you need to go. If they look at your cap table and you've given half the company away and you have yet to raise any capital, and you have to raise multiple rounds, they may look at that and go, man, by the time you capitalize this company, the founders aren't going to have anything left. And they may have to either help you restructure that, or they might just kind of run away. So your cap table becomes very important to investors. And the other thing that they'll pick up on is if you have an investor or a previous investor or an employee that has a large percentage of the company, they're going to ask about that, especially if you've given away a bunch of equity to a co-founder and they're no longer there and not adding value. They're going to really wonder about things like that.
Yeah.
How do you get rid of that person?
Yeah, and it's not easy if you haven't set things up right, which kind of takes us back to a point that if you're at a point where you're going to be raising capital, make sure you're set up correctly. Even from the very beginning, as you're starting to divide out equity among founders, make sure there's vesting schedules in place to where a co-founder wouldn't be able to leave after 3 months and take 30% of the company with them. Which is going to make life really difficult for you going forward, and the rest of the team.
Yeah. And that's got to be a pretty big question. And does Carta help with this next question that I'm about to ask? Because I would say that one thing that people probably really struggle with in the beginning is trying to figure out how much of the company they should actually be giving away, especially in the pre-seed portion.
Yeah.
Because just like you said, I bet a lot of companies are probably over giving in the beginning and then are probably hard stretched once you actually need those big rounds of funding. And so how much should these founders really be giving away? And is it strictly based on the valuation of their potential market?
Yeah, excellent question, Austin. And I'll tell you, there is much more art than science to this, but there is definitely some science that you can kind of look to in terms of data benchmarking. So one of the things I tell all the startups that I advise and work with is to make sure you have a good startup attorney, one that's experienced with startups, because one, they're going to help you set up your company correctly. Two, they're going to be able to help you benchmark things like that. And if you're thinking that you're going to give a new co-founder coming in 50% of the company, that hopefully they'll help you to guide you along that path. Or if you've got multiple co-founders, figuring out what are the benchmarks from you as a founder and how much have you done so far to get to this point. Maybe you're bringing on a CTO or a technical co-founder what's the right amount of equity to grant to that individual. But then it becomes even more tricky as you start to get into issuing stock options to employees. And there are benchmarks out there, based
Mm-hmm.
on what stage or level the company's at, what the position is, the seniority of the position. Is it an executive level? A good startup attorney will have those benchmarks, and they'll know what's standard out there. There's also some great articles out there. I know Tom Humphrey from Access Venture Partners in Denver wrote a fantastic article that has some great benchmarking data in regards to how much equity to give out, based on the pathway of the company and where you're at, what stage the company's in.
It's a really important part, though, because I think it's super funny, and we ended up actually talking about this in our previous episode. But I feel like for most people, going and actually talking with an attorney for some people just like gets people shaking. But this just really goes to show that like this step here is probably going to make or break your company if it's not done right. And so it's definitely better to invest the couple thousand or whatever it is to have your company set up correctly and to be knowing how much it is to give away than to lose out on potentially millions, right? And for some people, it's just not easy for them to understand or
Well,
fully
it's scary
grasp.
because they think, an attorney hourly retainers are so expensive. They're like, we're not there to that point. But it sounds like that should be one of the first steps we take.
Yeah.
Absolutely. And you think about it, if you're setting this company up for success, even if your attorney's charging $500 an hour or something, to have them at least review things before you set them in stone is well worth it. Because if you make mistakes, and your company is successful, you can be talking about potentially millions of dollars, by setting
Yep.
things up incorrectly, or at least tens or hundreds of thousands, not necessarily in legal fees, but also in legal fees to clean things up down the road.
Yep. For sure. Talk us through what a cap table is. So, a lot of our investors might, or a lot of our founders who are listening, we might not understand what a cap table is because they haven't really thought about this aspect of their business. Can you kind of explain what a cap table is and why that's so important?
Your cap table is really just a tool to keep track of the equity or the ownership in your company. At a basic level, if you've got two founders, your cap table is going to be really simple. One founder has 60% of the equity, the other founder has 40% of the equity. As you start to get more complex and you start to get investors that come in, that's going to decrease the percentage of ownership of the founders, and you'll grant equity or additional shares or units to your investors. And then you start to bring on employees and granting them equity or even stock options. You've got to keep track of all of that. Your cap table is what keeps track of the ownership of the company. Oftentimes this has been done through spreadsheets, historically. Most companies are now doing that through software, when you can issue the equity right out of the software, and then it automatically updates your cap table and keeps track of where the ownership percentages are for everybody. Anyways, hopefully that answers a
Yeah.
high level question
No,
on the
that makes
cap table.
a lot of sense. And it's funny, we've talked to several of our guests on our show, and they've talked about cap tables and why it's important, or at least they've kind of just talked about the importance of cap tables, but we've never really talked about what it is. So I feel like for those that have been listening, I hope they kind of get a better idea of like, okay, that makes it kind of organizes where equity. And again, at the beginning, it's probably not that big of a deal. You own 60%, I own 40. But as you start growing and you start getting employees and you get investors, that can start getting pretty convoluted pretty quick. And so if you have something in place right now, it makes it a lot easier, and it keeps you from really stumbling in the future.
And I think along those lines, if you do it early and do it correctly at the very beginning, it makes it a lot easier to have that in place when you do bring on a new co-founder or a new employee that you're giving equity to, or an advisor, or ultimately investors. And then as you do that, just making sure that you update the cap table at the time of every equity grant so that you're not leaving that to catch up later and then forgetting about it. I'll tell you, at Carta, we have almost 20,000 companies using the software now. And I think we can say that about 80% of the cap tables that get put onto Carta have to be corrected because they have errors in them. And so just that whole process, I mean, most cap tables are not correct. And so making sure they're correct from the beginning and then using software to keep them updated and corrected throughout the lifetime of the company just makes a ton of sense.
Yeah. And to kind of back up a little bit, tell us a little bit of the experience that you have with brand new startups, and specifically like tech. And what are some things that you've seen just in general that they've done really right, and in terms of seeking investments and building these cap tables, and then some things that they've done really wrong?
Yeah, that's a good question. So startups that have done things really right, I think, from the very earliest stages, creating connections and networking with potential investors and just the startup community, I think that's something that you can never do enough of. Sometimes a founder will get too buried into just creating the product and forgetting about the importance of networking and keeping those
Yeah.
relationships alive so that when you do actually have a product that's working and you're getting traction, you've already had those conversations, you have those relationships, and you can keep updating investors as you go if that's the path you're going down. The other thing I've seen companies do really well, and I guess on the flip side very poorly, is validating their ideas. I work with a company and sit on the advisory board for a company that, they had a really cool idea. And, instead of going out and just building the app, for example, they went out and interviewed 120 customers. And as a founder, I think you have to be willing to do that and talk to customers or potential customers and get that feedback before you actually build something, because they learned in the process that, oh, some of these things that we thought were going to be super important, it came back that the feedback that no, that wasn't as important as maybe this feature. And if we did this feature, then it makes it even more valuable. And so we had to focus more of our development on this instead of that. On the flip side, you've seen founders that think that they have a fantastic idea and that everybody's going to love it, and they go and build it and they spend 50 grand creating an app or whatever they do, not to mention the time and the
I've
effort
seen
that they
hundreds of
put
thousands
into
spent.
this. And then they try and take it to market, and they go talk to customers, and nobody really likes it.
It's not what
Um,
Yep.
and so now you've gone to market before you've actually gotten the feedback. I mean, just that whole process of validating your idea up front is critical. And I know you guys had Eric Espinoza on one of your shows, and
Yeah,
venture
Eric's smiling
value.
right now listening to this.
Yeah,
So
sure.
it's
Yeah,
kind of funny. I
Yeah.
do
yeah.
have a story. I do have a story that's very similar. I went up to Brigham Young University in Idaho there, and we had a really great marketing program. And we went and did a validation. So a company came in, an actual company in Rexburg came in and wanted us to find out what was most important for their customers. And they had pushed heavily organic beef. They pushed heavy, no CMOs, and they just wanted a really healthy food was their big push. And we went and interviewed 400 or 500 people, did surveys, and we presented in front of these restaurant owners, and their top things was value for food, cleanliness, and environment. And the owners just like sat there and they looked at each other and be like, why are we spending so much money on organic meat? That's not even on the list. They don't even care. It was a shocking moment for them. They seriously, I just remember they looked at each other and they're like, what are we doing? Why didn't we do this at the beginning? Why didn't we validate this idea? And that's one of the things we want to drive home to all of our listeners. Validation, number one, does not have to be expensive, right? You can do it. Get outside of your own personal bubble of who your friends and your mom are going to say that you're beautiful no matter what you say, right? Same with your ideas. Now, when it comes to investors, tell us kind of the difference on what an angel investor may be looking for and what a venture firm might be looking for, and kind of how those differ, because obviously they both need that validation, correct?
Oh, absolutely. And in fact, when you're going to present to any investor at the early stages, I think one of the things they're going to look for is, have you done the validation? Have you gone through the, talking to customers? If you as a founder aren't willing to go out and talk to customers and get feedback, that sends up a red flag. And I think you have to go through that process of validation and show the investors that you've done that. So at the earliest stages, when you talk about the difference between angel investors and your VCs, the venture capital firms are going to be more institutional based. When you're talking about venture capital firms, realize that the individuals you're talking to at the firm, they have a responsibility to their investors. They are investing other people's money, and they have a fiduciary responsibility to get a good return for their investors, right? And so they're going to be looking at it from that angle. You look at an angel investor, and they probably have a lot more leeway. If it's an individual angel, this is their personal money, and they can
Mhm.
say, "Yeah, I like this idea." They may want to be more involved. In fact, if they've got a real passion for what you're doing, they may jump in and say, "Hey, what can I do to help? I'll give you money and this." That can be good. It can also be bad. So, you
Yeah.
kind of have to figure out what you want and what you need. A VC on the flip side, they don't want to run your company. That's the last thing they want to do. They want to invest in you as the operator. They're saying, "We believe in this team, that they're the right team to execute on the plan that they presented to us that we believe in." And like I said, the last thing a VC wants to do is come in and run your company for you. If you get to that point, they're going to want to replace you as a management team, because they're investing in you as the management team to take things to the next level.
I was just going to say, talk to me about the time frames. I feel like in an angel investor, getting funding could probably be a lot quicker. Would you agree? Just because it's their money, and then be like, "Yeah, I want to move that forward," or do you feel like that's not as? Do you agree with that?
I think that's it can be for sure, but I think the speed in terms of how quickly you can act is probably more on the where you're at and what and the fit that you have with the investor. You might talk to 100 angel investors and just to find one that's interested in wanting to invest. I think the other thing that they'll look at is a lot of times they look at who else is interested in investing, and sometimes the angel investors won't invest unless certain other individuals have looked at it and agreed to it, and they end up being just follow-on investors. And so finding the right fit of an investor, it doesn't always happen real quickly. You have to talk to a lot of folks typically, whether it's an angel investor or a venture capital firm.
Yeah, I feel like we've been in a lot of conversations and with people in terms of like getting money. And to your point, like as soon as one person actually commits and makes an investment, it's almost as if it's super weird. Just because one person has made that commitment, now other people are now more comfortable. I don't know if it's like, oh, I mean, if I lose my money, I guess I'll lose it with this guy, like kind of like thought process, or however it works. It's super interesting to watch, and we tell a lot of the people we talk to, it's like it's going to be hard to get that first one, but once you do, typically you start to see a couple more people willing to kind of trickle in and jump on the bandwagon, and start investing in your product.
Very
Um,
common. In fact, you'll see often that investors will wait for that lead investor because they want to follow. And if you get a good lead investor that's willing to put in half of the round, then it's pretty easy for another investor to kind of say, okay, they've taken a pretty good look at it. They're willing to go in at a decent clip. We're willing to follow that lead. And you see that happen way too often. But
yeah.
finding that lead investor is the hardest thing. And so one of the tricks you do see out there is, if you're out there raising capital, you want to get as many investors or potential investors committed as possible, even if they're going to be, a $50,000 investor out of a, $500,000 round or $1 million round.
Hmm.
A number of those, if you can get them and then, say that you have, half of the round filled or soft circled, um, waiting for that lead
Mm-hmm.
investor, then that helps to instill confidence that okay, others are interested. We might want to take a look and maybe dig into it a little bit deeper. I think the hardest is that your first investors that are willing to commit,
Yep.
that you could even say are soft circled.
Yeah. And one thing that's going to come up for sure at some point as you're going through and like talking to these angel investors or private equity firms or whatever is going to be valuation. And so I know you talked about that just briefly, but how, let's say, one day I'm just like, hey, I want to like evaluate my company. Do you actually have to hire a third party person to do it? Or is there some sort of like magic trick or thing that you can do to find the valuation yourself?
It's again, that is more of an art, and it's not going to be. I mean, it's going to be a negotiation, regardless, with your investors. You're basically
Yeah.
you as a founder may think your company is worth $5 million. The investor may look at it and go, we'd be willing to put in X amount of money at a valuation of $4 million. And if you push too hard and say, okay, well, we have to have a $5 million valuation, then the investors can always figure out ways to make that work. They can say, okay, we'll still invest the $1 million, for example, at a $5 million valuation, but we're going to have a 2x liquidation preference on there where we get our money back first before anyone else gets to participate. Then it's taking away some of the
Mm.
risk for me as an investor. And so it's not all about valuation. You might go in as a early
Yep.
stage founder and say, "Oh, I have to have a $5 million valuation on this company." The investor can get there, but it may not be the best deal for you as a founder. You might be way better
Yeah.
off taking a $4 million valuation and having better terms. Again, this goes back to why you should have a good startup attorney, because they'll be able to see through things like that, and be able to compare term sheets. Best thing you can do, get multiple term sheets. If you've got multiple investors that all want to invest and they have different term sheets, then you have something to compare and say, okay, what do we like and what don't we like about the term sheets?
It's kind of like crazy how many different things go into it because it's as we were talking with the accountant or like our accounting and finance podcast. It's at the end of the day, it seems like valuations are all about how you spin the numbers, not really what's there. And to your point, yeah, it really just turns into this negotiation, and they just call it at the end. So that's super funny.
Yeah, and again, it comes down to this is more of an art than it is a science, and that's the more I learn, the more I listen to these podcasts. So let's go into a scenario where, Jeff, I got a really great idea. I validated it. It fits the market really well. I'm going to need X amount in funding. What do you think our first steps should be on moving forward? I mean, you personally have raised money, but you work with a lot of startups. What do you think would be really important for me to do as my next maybe 3 to 5 steps?
So if you've got a product or a service or something that you have traction, it's really about getting it to that point where you've validated it to the point where people are willing to pay for it. So if you've established that, and then you can put some metrics together that show, if we spend this much, our customer acquisition cost, for example, is X, we get this out of it. And if you've got a formula that you can show to an investor that if we put in, $1 million, this is what we get out. That's a great scenario for an investor,
Mm-hmm.
right? Now, if you're earlier and you've just run out of money and you've validated it, for example, but you still need to actually get those metrics and figure out what that is. I mean, you start to present to the investor, and you're looking now for individuals that believe that this can work. They're going to help you validate it, I guess, if you're at that stage. It really is. It really does all come back to validation.
Yeah, I was just going to say most people listening to this are probably people who haven't validated the product or gotten a product on the market yet. And so let's assume these people are just people who know that there's a demand for their product, specifically an app. They know there's a demand for some sort of solution that they've created, but they don't have a physical product and a proven like strategy. Obviously, like the next step would be to get that built and to prove that it works. But how often do you find that VCs are comfortable with the idea phase? And with the idea phase, how much information do they like to see? Is it just like a couple screens of the app and how it works? Is it like 1,000 surveys? What kind of information can we actually give to these, investors to really convince them to give money for the product?
First off, when we're talking about what you can give to an investor to, initially kind of present to them, there are great examples of pitch decks from, if you're in a seed round, go to companies that have published their seed investment round, how they raised their first capital. There's examples out there and good ones. If you're, looking for that next stage of Series A, that, look at companies and what they used in their pitch deck to get that Series A investment. But you do need to put together a good pitch deck. And there are key slides in there that you're going to want to hit on. A lot of it's going to be focused around you as a management team. Like I said earlier, they're going to be looking at you and making sure that they believe that you're the right team to execute on this idea. But putting that pitch deck together and then going out and practicing. I mean, if this is new to you and kind of your first time pitching, I would go to the local Million Cups, the 1 Million Cups events, and present there. Get some practice. You've got one in Salt Lake here. You've got one in Provo. You've got one in Ogden. Hit all three of them and practice your pitching. You'll get feedback and practice, and then maybe move into some of these pitch competitions. And there's a ton of them out there, whether it's virtual or hopefully we get back to some of the more in-person ones. But practice your pitch.
Yeah.
And and then clean it up. Take that feedback that you're getting and adjust it to where now you're able to get in front of investors and it's just like clockwork. You can totally present it, the ins and outs, you're prepared for every question.
It sounds like if you don't have that traction or that product or that proof, you need to make up for it with an excellent pitch deck, very polished and ready. You'd say that's how you close that gap?
I don't know that an excellent pitch deck is going to make up for a mediocre idea or company or team, but I think a compelling story is kind of what you're going after. Something that's going to, convey, one, that you have a market that you can get into, that there's demand for your solution. I guess it starts with a problem, and that you have a solution and that there's a market for this solution. And then ultimately that you're the team that can pull this off and create, value that, makes sense for an investment. So again, it's a compelling story that yields confidence from your investors to say, okay, I believe that you can execute on this plan that you've put in place. We'll give you a shot. If you're going down the path of VCs or even angels, they probably see hundreds, if not thousands of deals a year. You're just one of many. If they see a company initially, it's probably just one of many. They hear about it from, another VC, or they hear about it from a couple more sources, and all of a sudden it starts to pique their attention. And then when they've heard it from like 7 different people or different areas, it's like, all right, we might want to take a look at this. Well, if you have somebody that knows an investor and then they can present it to them and say, hey, this is a super cool company, I think you ought to at least give them a shot, listen to their pitch. Coming from something like that is going to have a lot more weight than a cold email to a VC that has no context. So that's the beauty of a startup ecosystem, is having those connections where a lot of the founders that you might network with, they're going to know a lot of the investors. A lot of the investors are going to know each other as well. Just getting into that community, I think is very critical of, getting references or getting, introductions to different investors or even other founders.
And I even think what you said holds a lot of weight. If multiple people know about it and they're all talking about it in the same industry, they're going to listen. They're like, wait, I've heard about this idea. I've heard about your company. Tell me more, rather than a cold email, right? And be like, listen, I've had actually 3 or 4 people tell me about how cool this idea is. I'm actually really excited to hear it. Tell me about it. And I feel like that holds
Right.
so much more weight than anything else.
Oh, for sure. Now, one thing to be a little careful of, I have seen this happen on the flip side, is
Uh-oh.
that a company goes too early to a VC and they're not ready and they pitch, and then it comes back to where, they've now validated their idea, or it's, things are going better, and the VC is like, oh, we've already seen them pitch. So in cases like
Oh.
that, one thing that I think you can do, you've probably heard the saying that if you go to an investor and ask for advice, you get money. If you go asking for money, you get advice. And in that context, I think you can approach, if you're early stage, approach these investors and say, hey, would you mind if you just gave me some feedback on our company? I'd love to get your feedback. And that's what you're asking for.
Yeah.
And then it gets you your foot is in the door. They've given you. Then you go implement their feedback and you update them. You ask them if can we keep you updated, and then you send a quarterly update. As progress starts to be made, maybe it gets to a monthly update. But you start sending out periodic investor updates so that they know what progress you're making and you're top of mind. That becomes a way to keep those relationships warm, so that when it comes the time where it might fit their investment thesis, or where their fund's at, you already have that introduction, and it's fresh.
Yeah, that's like setting up your ducks before, right? Getting everything in line. So when you're ready, they're all right there. You can just knock them all over.
Yep.
Yeah, you've got both your customer list and your investor list. kind of fun there. I love that.
Cool. So I want to have I kind of a quick question when it comes to, what do you feel like the biggest misconception is when it comes to getting money?
I think founders too often get caught up in the glory of raising a fund, raising a round of capital. I think what they don't realize is when you take on venture capital, your life changes, because your venture capital investors, they are responsible to their investors to get a good return on this investment. You as a founder are now under pressure to perform at the level that they need. When venture capital companies, just in general, are making bets on your company, they're not betting on, that you can turn a company that's doing $100,000 a year in revenue to $200,000 in a year, and they're jumping up and down. That's not going to happen. They're looking for you to be the next billion-dollar company. And in order to do
The
that,
next unicorn.
that takes a lot of work and a lot of commitment. And you better be ready, because that's the expectation. If you start to fall behind, you're going to start to lose interest from your investors that were so bullish on you from the beginning. And if they see that you're kind of starting to really fade, you're not going to have their support, and it's going to be harder and harder to raise capital if you're not consistently hitting those milestones. So again, you're not only on a milestone, measurement, but you're also on a time clock, because they have to have these investment returns, over a period of time, and they're getting pressure from their LPs to, how well is this company doing? Oh, they're not. Well, let's not focus on that one. Let's focus on the ones that are doing well. So venture capital is not for everyone, and there's a lot that comes with taking on venture capital.
Yeah, I feel like a lot of people we talk to, majority of them are like, if you can run your business without getting capital, always do that, for the reason that you just said. Like, as soon as you start putting expectations on the money that was given to you and your company, you've now got to execute, and you end up starting to focus on things like getting more revenue instead of making a better product or talking to the customers, which I would say for most founders is passion is probably the main reason they get into their space anyways. And soon as it's no longer that passion and just hitting benchmarks, your overall idea of what you're doing is, you kind of got to reflect and really start asking yourself questions of like, is this really what I want to be doing?
Right.
Because there is, like you said, so much pressure with that. So, I mean, as we go into the end of this, I mean, one question that we like to ask everybody is, what's the final piece of advice that you would give to these new founders that are just getting started, probably pre-revenue, no designs? What advice would you give them besides validate your product?
Yeah, I think we hit on a couple. One is definitely validate, talk to your customers, get that feedback. Two, we already covered as well. Get a good startup attorney, set things up correctly from the beginning. Surround yourself with good advisors and mentors that have done this, so you don't have to make mistakes that they've already made. So that's probably, that would be my advice to early stage founders that haven't done this. I'll tell you, most entrepreneurs and successful entrepreneurs that have done this before, they love sharing the mistakes that they've made and what they've learned. Take advantage of that. And as a early stage founder, take the advice from mentors. Go find a mentor and let them coach you.
Well, and Jeff, you also forgot one thing too. You probably want to go get a free Carta account because it doesn't cost anything if you're under $1 million, right? You forgot to do your plug right there.
There you go. You can do that for me. I mean, yeah. It's definitely look at Carta. And I mean, if you're looking at your cap table, setting that up, it's free for companies that have raised $1 million or less, and have 25 or fewer stakeholders. Easy way to get set up and present well to potential investors in the future.
And you look like you're super active on LinkedIn. And so where can everybody find you? Are you most active on LinkedIn? Are you anywhere else?
Yeah, you can always find me on LinkedIn. That's probably the easiest. Feel free to reach out and ping me. Just Jeff Erickson there on LinkedIn with Carta.
And as you can see by this podcast, Jeff's a rock star. He's just a guy full of knowledge. So we always like our listeners, to reach out and follow. We follow your LinkedIn now. You have such good content. It's awesome to have. Also working for an awesome company it could be a great tool for any of our founders who are listening. Make sure you guys look that up and kind of go from there. So anything else, Jeff, you wanted to say to any of our listeners?
Yeah, I'll give one last plug, and that's for something called the Startup Stack. If you go to mystartupstack.com, it's specifically for early stage founders. There's a bunch of free offerings. Carta's part of that. But there's a lot of different tech providers that can give you tools that you need as an early stage founder. I think Venture Validator is part of that. And they have special discounts just for early stage founders. A lot of them are free. So cool. Take advantage of things like that.
Yeah.
I love that. We're going to have to reach out to these guys. This is super cool.
Yeah, this is way cool. I'm on right now.
Sweet.
Awesome.
Well, thanks, Jeff, for jumping on. Really appreciate you.
Absolutely. Our time went way
You answered a lot of really hard questions.
I'm like late for my appointment here. So I better jump. But this was awesome. Thanks, guys. Great to meet you.
All right.